right, good afternoon, everyone. This is MOHAMMAD BURQAN, Chief Market Analyst at STARTRADER, where we offer products and services for either individual or beginners clients to institutional liquidity and back office services. In our company, we are targeting all the broad services in the Forex market, and we are known for the advanced technology and our innovation in the fintech sector. Talking away of that, we decided to let you know how to collect the puzzle about what's going on in the market for the time being, about the energy market, and what is the effect of each decision or each news we hear on daily basis, either on social media or in newspapers, how to collect these pieces together to have bigger picture and what to expect on the energy market in the next 6 months or 12 months. So starting with the energy market under the microscope, we'll be dealing as a game. It's the game of natural gas and crude oil. Starting with this, let's start with the journey of crude oil news and crude oil market since late 2021, when natural gas started showing some shortages in some countries, especially the UK and Euro area, or Europe in general, due to postponed services or maintenance for the storages and reserves in that area that were postponed from the pandemic time to late 2021. These services had to shut down some of the reserves there, so they had shortage in the supply in the Euro area. But moving next to it, in December 2021 specifically, where Russia decided to switch the supply from Euro area towards Asia due to the higher demand in Asia and the willingness of the Asian countries to pay premium for the energy that they are importing from Russia. Moving next will be when we started seeing OPEC Plus members gathering and on Zoom meetings and decided to increase the production of their countries around 400 to 500,000 barrels a day. At first, when the economies or global economy started having some recovery signs after the pandemic era. That pandemic affected the growth and the infrastructure of all countries around the world, but mainly the industrial countries that got hit the hardest, where they couldn't run their operations properly due to the lack of workforce in this area as lockdown was there. But when we moved after that, world started seeing some recovery and the economies started having some signs of positive energy, and markets started seeing some signs of profits in the as linked to the economic growth. In 24th of February, we had the Russian-Ukrainian war that started setting some restrictions and some effects on the supply chain of the crude oil and energy products, especially when European countries decided to reduce the importing of energy products, especially natural gas from Russia, and that affected their supply a lot, which led the prices of energy in Europe to increase dramatically, especially in UK, that is now is suffering from the increase of prices of energy, and you can, I'm sure you heard about that. Their bills are doubled or tripled in the recent few months. But then in Q2 and Q3, all the hopes of recovery after the pandemic started collapsing when countries started loosening the restrictions and lockdowns, but then we saw that the economic growth was not as expected. So we saw in the market that the demand we see is not the demand we expected a few months before that, 6 months before that area. Let's say in early 2022, we expected the demand to be way higher than it was in Q2 and Q3. But then also another restrictions were set on the Russian economy. When Europe also cut down a lot of their imports further from Russia, which covers almost 47% of the European energy. So having that said, the economic growth in Euro area dropped dramatically after that. Like, it was not able to recover from the pandemic properly. Plus these restrictions and the increase of energy prices that hit the market hard and started the last spark of the inflationary pressures in that area. Then in September, we had the big news when Nord Stream 1, which is the largest supplying line from Russia to Europe, was shut down. That hit really hard. That caused pain in the markets, caused traders to rethink about their strategies for energy, and whether it's crude oil, natural gas, and even renewable or sustainable energies, because all of that changed. Nord Stream covers 20+% of the energy consumption in Europe itself, which is a huge portion. If you are thinking about just one line, covers almost 20 or 25% of their whole energy consumption. And then OPEC Plus came with the big news that they had decided to cut their production to 2 million barrels a day, instead of having raised their production in the first 3 months of the year by almost 400 or 415,000 barrels a day for 3 months. Then they cut for 2 million barrels a day, which is 2% of the global consumption of crude oil. In October, this month, when OPEC decided to cut these 2 million barrels, and they released their statistical bulletin that we follow up at the end of each month, we noticed that in the previous 2 months, production of OPEC Plus was less than the target by 2.5 million barrels a day, and almost 3 million barrels a day in the past 2 months. This news also affected the global growth again, which led to really negative consequences in the energy market, economic growth, and the exchange rates for these currencies. We can see the pound is going down away from the pressure that is related to the monetary policy and fiscal policy in UK. The increase of energy prices affected the exchange price also for the sterling pound, because of the increase of cost on the country, that they have to pay a huge premium to import energy and natural gas, as they offered 4 times the price of natural gas to be imported from the US, which was a huge percentage. Then, now we will be talking about, we talked about geopolitical events, we talked about OPEC plus production, but then how countries could cover all of these shortages. Like, they have more than 10 million barrels a day of production from Russia that is now restricted. So other countries started looking for other resources. One of them is the strategic reserves. US and China and Japan decided to release some of their strategic petroleum reserves, which is now, as of yesterday, it's in US, the strategic reserves are the lowest level since 1986. All of that just to cover the cut of production from OPEC Plus, which is total of almost 5 million barrels a day over the past period, and the restrictions on Russian economy. Also, when we think about it on the other way, they started looking for other alternative resources of the data, of the crude oil. So one of the options that they started pursuing is the Iranian reserves. Iran can produce up to 4 million barrels of crude oil a day, which can cover almost 40% of the production of Russia, plus the 180 million barrels of crude oil that US is ready to release in the market. That can cover some kind of like 40-45% of the production that's cut from Russia in the past like few months. Plus, they can sustain for the next 3 to 4 months in that. When we're talking about the production levels, as we can see here, the production level for liquid fuel, which is mainly crude oil, we can see the production has increased during 2020, 2021, and 2022, early 2022. But the expectations for it, since if you can see here, in this area here, it started going in flat line. And it started matching exactly the demand and consumption of the global economy. At that point, when we have low consumption and when we have low demand due to the economic growth, the problems in economic growth, OPEC Plus, which controls 2/3 of global oil reserves, just started matching the consumption and demand in the world. This will put crude oil under pressure and demand under pressure, which means they will lead countries to pay even more and pay premium, higher premium for importing crude oil. If we are looking for the other chart there, we have the components of the annual change. We can see in this chart here that OPEC in 2020, they reduced the production here in huge part, like almost 2 to 3 million barrels a day during the pandemic time, but then they started increasing it slowly. So in 2021, we increased just 1.8% in the production, despite the recovery of the changes here, or the recovery that was expected in the market. But then in 2022, the forecast of OPEC was to have a growth of 4.4 million barrels a day, or 4.4% of the production levels. But in fact, when we move later on, we can see here also the petroleum export countries, which is OPEC, the surplus production. Here we can see that they were producing at almost marginal levels on these levels. The surplus they had, it was like almost 5 million barrels a day. They could produce 5 million barrels a day, but now they are, after the restrictions on Russia, they are pressured to produce more from these countries like Saudi Arabia and other countries, which now they have only a surplus available to push in the market for 2 or 2.5 million barrels a day. This is not enough because the market, only Russia itself, out of the exporting countries, will cut the production of 10 point something million barrels a day. Even the surplus we have here is not enough to cover it. If we are thinking about Iran, the crude oil in Iran, Iran is able to produce 4 million barrels a day. Of a total of 7 million or 6 million barrels a day, we are still short 4 to 5 million barrels a day in the global consumption. So here we can see the expectations of the growth and what happened to the economic growth. We mentioned that several times in the previous slides, but when we're talking about it here, the expectations for global growth is 3.1%. If you can remember what we said about the 4.4%, the expectation. So OPEC Plus and IMF decreased their expectations for the global growth from 4.4% to 3.1%. Will that affect the energy market and the prices of crude oil? That will for sure affect it. When we think about the consumption levels, our consumption level globally now is 102 million barrels a day. So any decrease in that is marginal for that, because the current production levels are 98 million barrels a day. So we have shortage 4 million barrels a day, keeping aside that Russian oil is now being exported to Asia. But if they restricted it more and Asia has no more crude oil or energy products from Russia, that will add more than 6 million barrels a day of shortage on these 4 million barrels a day of shortage. So these numbers here are the production and the consumption level for each one of these countries or regions. We have the Americas, which is US mainly, consuming 24% of the global production of crude oil, which is massive. But when we think about it, in the US, they have their own WTI production. So they can cover a huge part of their consumption of crude oil, plus the reserves that they are willing to release now. It's 180,000 barrels. They have it. We can take them out of this equation. But when we think about other countries like China, the second largest crude oil consumer and the largest crude oil importer in the world, they are consuming almost 15% of the global crude oil production. Here we can see exactly what Europe is going to. Like, we finished the global look about the energy market. We talked about the globe, how it affects the demand and supply based on the current situations. But the most countries that are affected by all of that are the European countries. They have high level of demand, but in the same time, they can't match the demand of the Asian countries. And they can't pay the premium that China is willing to pay for the time being for any amount of the crude oil and energy they are importing. Plus the restriction that they set on Russia. So they have huge shortage. If we are looking at here, we can see that 37% of the natural gas that Euro area is importing comes from Russia. 20% of coal and 25% of crude oil. So in total, that will cover almost 47% of the amount of energy that the Euro area is consuming. That's 47% of the demand in the Euro area comes from only the Russian region. If we're talking about the overall energy, it's 58% of it is imported. So like, it's almost 60% of their energy they imported from outside. 47 is just from Russia. So they have only 10% that is imported from other countries than the Russian region now for the Russian production. And here is this chart where we can see each portion of the energy consumption and the energy they are using. Going back to the demand and the price and why exporters prefer Asian region than European region for their exports. Because we can see here the lowest consumer of the top 5 consumer in Asia is higher than, it's 5%. It's higher than the top consumer of Europe. So whatever the amount is produced, Asia can consume it. The Asian countries, they have the demand and they have the willingness to pay more than the European area as a premium on the prices. That's why in the first, when we said Russia shifted the supply from the Euro area toward Asia, because of this, because they have this amount of demand, we can see like all of these. Spain is the largest country as energy consumer in Europe, but Taiwan, among the top 5, it's the lowest. Still, Taiwan consumes way more than Spain. Here we are talking about, just to wrap things up, the changes in prices for energy products. Mainly we are talking about natural gas and crude oil. Since the beginning of this year, we have seen the changes in crude oil prices increase by 16%. This 16% increase is after the cut of production. We have low demand, we have low supply, and still we are seeing crude oil prices are going up, or OPEC Plus are trying to sustain the prices at this level. As they said in the last meeting, they said the goal of OPEC Plus is to control and sustain the security of energy markets. And all of that comes with a price. So the price is the premium that the countries are forced to pay to be able to cover the energy consumption in their countries. But when we are talking about natural gas here, it's 97% increase in the price since the beginning of this year. This is double the price when they started, and we have the winter coming. And we know like Europe in winter has high consumption of natural gas for heat and for electricity. That increase, that 100% increase in the prices since the beginning of the year is just the start before even the season of winter, the season of high consumption in Europe. Will they be able to pay the premium to take the consumption, to take the supply from the Asian countries towards Europe? That is the pressure that these countries are affecting, and that's what I want you to think about it. I'm not going to talk about it because I'm talking about energy here, but think about it this way. Will European countries be able to cover this premium that might go even another 100% or 200% based on the prices that the US offered to Europe, which is 400 the prices that we started this year, which means another 200% on this price. And think about the effect of these increases on the currency exchange rates for euro and sterling pound. That will increase the effect. But just to finish that, when we think about the current OPEC targets and the forecast, OPEC Plus said in their last meeting that their target is not the price. They don't have specific price to target among these increases of demand and cuts of production. But when we think about it, isn't that what they are doing? So whether in direct or indirect way, that's what they are doing. They are pushing the prices higher, and they are asking for higher prices for their products. They're asking for premiums from certain countries, especially the European countries, to be able to take that amount of energy towards Europe from the Russian regions. So we will have three scenarios in mind. The first two are easy. If OPEC Plus failed to control the prices with extra cuts, and we can see now that the second largest economy in the world, which is Chinese economy, is still going backward in growth. So will that be demand? And there is no demand if they can't control it. So the prices will drop around $65 to $75 a barrel. Otherwise, if they can control it and if they continue to cut production further, as they mentioned in an indirect way, of another 2 million barrels of production. So we are expecting the prices by the end of the year to be between $100 to $110 a barrel for WTI, and which means that $120 to $125 a barrel for Brent products. That's what I wanted to say, these pieces of this puzzle that I wanted to mention for you. Thank you everyone for listening, and if you have further questions, you can feel free to visit us at booth 80. Me and my teammates will be more than happy to assist you and answer all your questions. Have a good day.